Ready to pass the CPA exam faster? Visit cpapass.ai. Today, book versus IRS differences. Why your two notebooks don't match. Imagine your company just suffered a massive net operating loss this year. Instead of just absorbing the blow, the tax code offers a lifeline, the opportunity to turn that loss into immediate cash through a carryback refund or future savings through a carry forward. On the CPA exam, you must understand how a net operating loss, or NOL, bridges the gap between financial reporting and tax reality. When tax rules allow you to offset past or future taxable income with today's loss, we must record the tax benefits immediately on our financial statements. Let's master these rules. To account for an NOL, you must first know the rules of the game. Under tax law, carrybacks are heavily restricted. An examiner trap is assuming carrybacks are always allowed. You must check the specific tax year limitations and the strict order of applying carrybacks to the earliest available years first. Also remember that permanent differences affect the company's effective tax rate, not the statutory rate, and never create deferred taxes. Any remaining loss is carried forward to offset future taxable income. Because this timing difference will reverse, a carry forward always generates a deferred tax asset. When a carryback is permitted, the accounting is straightforward because the benefit is realized immediately. We calculate the refund by multiplying the loss being carried back by the tax rate of that prior year. Because this is an active claim for cash from the government, we debit income tax refund receivable. The credit goes to income tax benefit from loss carryback, which appears on the current year's income statement. This journal entry immediately improves both your balance sheet liquidity and your net income, reflecting the cash you are legally clawing back from the IRS. When we carry a loss forward, we don't get immediate cash. Instead, we get a future tax shield, which we record as a deferred tax asset. We debit deferred tax asset and credit income tax benefit from loss carry forward. However, if it is more likely than not, meaning a greater than 50% chance, that we won't generate enough future taxable income to use this asset, we must establish a valuation allowance. We debit income tax expense and credit the valuation allowance, which acts as a contra asset to reduce our deferred tax asset to its realizable value. How do these items look on the financial statements? On the income statement, the tax benefits from both carrybacks and carryforwards are presented as a reduction of the current period's operating loss. This is called the income tax benefit, and it is shown right below pre-tax loss to arrive at net income. On the balance sheet, remember the strict classification rule. Any deferred tax asset arising from an NOL carry forward must be classified entirely as non-current. Never classify a DTA as current, regardless of when you expect to realize the future tax savings. Let's walk through a practice example. Suppose your company has a $100,000 net operating loss this year. Tax rules allow you to carry back $40,000 to a prior year when the tax rate was 30%, and carry forward the remaining $60,000 to future years when the enacted rate is 25%. First, calculate the carryback refund. $40,000 times 30% equals a $12,000 receivable. Second, calculate the carry forward deferred tax asset. $60,000 times 25% equals a $15,000 DTA. Your total income tax benefit on the income statement is $27,000, reducing your net loss to $73,000. Practice more simulations at cpapass.ai.